Right, okay, well, thank you for joining me. I was going to cover price action today, and this is a real high level whiz through. And if there's more of an interest in me going deeper on it, then I shall do in kind of future midweek mastery sessions. Really, this is just about what it is, um, the key concepts around it, what people are doing, and then I was going to go through a kind of real world trade that I've done, just closed out today actually, which is pure price action based. So I'll figure out how to move down on this. There we are. So what exactly is price action? It's a term that's bandied around an awful lot, but really it's about reading the market and making decisions based on actual price movements rather than technical indicators. You don't need any technical indicators at all on your chart for it, and sometimes when your charts are clean and just showing price, that is the best way to do it. It's also the best way to learn. It's kind of the oldest discipline in trading, and it's the hallmark of people like Livermore and Darvas, an awful lot of the market wizards. The pit and the floor traders, that's really what they use. Tape reading and order flow are kind of modern sort of versions of it, if you like. These guys didn't have PCs like we have today, and they didn't have all the fancy analysis that we now have. So they rely purely on price action, and it's their kind of, I guess, the groundbreaking work that they did that is what is made of it today. You also find most of the technical indicators we use today are based around the price action concepts as well. It is pure trading. It's not investing. It's not for the longer term type stuff. Fundamentals are not considered at all when you're looking at price action, and there are either none or very minimal technical indicators in their modern form. At most, you'll get an average or two within it. It is highly complex compared to most forms of technical analysis, because you are looking at market participation and things like that. It's not simply just reading, waiting for a cross of an average or a technical indicator to show up rather than down or any of that type of stuff. So it's more complicated and harder to master. It focuses really on the relationship of where price is at the end of this bar compared to its recent or longer term price history. It makes no real consideration of the value of that price. It's irrelevant, really, in most cases, what the actual price is, which is not the case for a lot of modern indicators. Like things like MACDs and all that are all based around the actual value of price. Another key thing about it is it's always carried out in real time. It's not a backward-looking discipline at all. You're always focused on the latest bar. So it's carried out in real time at the right-hand edge of the chart. There's no other place that you can do price action analysis or trading. And it's not particularly well documented on its own. There are no real seminal textbooks or resources to go to around price action. It is, however, referred to and commented on frequently throughout some of the classic texts, but it's never really fully explained. So you see it being referred to, this price action and that, but they never explain what they mean by that. And it's commented on quite a lot. I picked up most of my knowledge around it through participating in online forums and discussions with other price action traders, rather than any textbook or anything like that. So saying that, I've put a few resources at the tail end of this presentation that will give you a little bit of an insight into what's going on here. So it's all based primarily on the behavioural analysis of the market participants, and it assumes they act as a crowd. And the key ones that it looks at, really, in terms of maybe a running order, if you like, are the key ones being scalpers. A lot of them are in and out of the market multiple times a day, so they lead to a lot of that intraday sort of price action that you'll see. Day traders as well, another particular favourite of price action guys. So they're trying to figure out what these day traders are going to do and when they make mistakes and so on. Swing traders, obviously a biggie. Swing traders are particularly easy to understand and know what they're going to do in any given situation. Position traders, as well, they're similar to swing traders. You kind of know what position traders are likely to do, and then institutional investors, probably the easiest of the lot to understand when they're coming into the market and what they're actually doing. And price action trading on its own is based around that human fallibility and the crowd behaviours, and it's trying to take advantage of that. So when we know that there's a particular support level, or even if something like take something simple like a flat base, you know where the swing traders are going to try and get in, and you know what they're likely to do. In that situation, and you're looking at price action to see when some people are getting a bit early without confirmation and all these types of things, and you're taking advantage of that, so you're going to trap them on the way down. And that's the whole kind of price action piece, if you like, how price action trades. It's based around what people are doing and taking advantage of those mistakes and the fallibility of humans when they act together as a crowd. And you probably see it 100 times, a week, with failed breakouts and failed trendline breaks and all these kind of things, where that human behavior fails, and then you'll see slightly bigger reactions to that than you maybe would otherwise expect, and that's where your price action guys are coming in and taking advantage of that, of other people's mistakes, really. So I just thought to reiterate that point, some of the common price action patterns, stroke signals that you'll see mentioned around the place. But trap traders are one of the very common ones. And this is swing traders. As I say, they're very predictable in what they're going to do because they're all looking for the same thing. Most of them are retail investors as well, so tend not to be all that sophisticated. And those failed breakouts and failed trendline breaks and all that kind of stuff you'll see as essentially people within the market, and they might be scalpers and day traders or even the institutional guys waiting to take advantage of these situations when the price action doesn't properly line up to say this is going to be a good breakout, and a lot of people get in a bit early or without actual confirmation. You'll see these things fail, and you'll get a breakout of 1 or 2%, and then the thing reverses by 7 or 8%. That's because people are reading that price action, knowing that it's going to fail, watching all these guys getting in, and then taking advantage of that. The 5-tick fail. This is one of my favourite ones, and you can read tick here. It's mostly scalpers and day traders that work in ticks, but day traders also do that, but for them a tick is a day. And a lot of people are looking for this 4-tick profit. It seems to be the kind of general case, certainly as of scalpers anyway. But you actually need 6 ticks in total to make your 4-tick profit. So when you see something failing at the 5th tick, and that's why I have this kind of 5-day rule, I expect price to go up for 5 days and then decline for 1 or 2, or at least go sideways. That 5th tick failure often signals an exit and a reversal, so you can take advantage of that and make a little bit of money in that case. As all those scalpers and day traders and swing traders, if it's a daily basis, that run for the exits to to get out either at break even or for a small profit. The barbed wire one is another quite common one. There's a lot of them about just now, but it's essentially when market trades in a fairly tight range that's going sideways. A base is a good example of that for this audience. Tends to be basing in a fairly tight range with reasonably high volatility, and that's where all the investors and so on get chopped up, because their signals to enter and exit are compromised in the extreme. It's how people lose accounts and all that, but that leads to lots of opportunities for somebody that's looking at the price action. They can just sit and wait for the right time, and often that would mean that something's bouncing along between a range of say $20 and $22. There's people trying to get in at the bottom of that, and they're just getting chopped up constantly. If you're looking at price action and waiting for the price action to be right for your entry signals, you're probably going to get in at $23 rather than in the actual range. So, and the last one I thought I'd point out, and I've not had time to look at get good examples of these, but I can certainly do it in a future thing, is the spike and channel move. And you'll see this an awful lot with earnings breakouts and things like that, where you get that one bar big move up, on day one, and then things go up in a fairly tight channel, but they kind of drift upwards. And that's your institutional order books, basically, that take a while to kind of work through. So you can see from all these kind of common price action type patterns, signals, what you call them, they're all based around that human fallibility piece. So you're taking advantage of that human behavioral element, and you're looking for that to come through in the actual price. So my take on sort of modern concepts, if you like, or how to build this into your kind of trading, is you normally start with broad technical analysis. So you're looking for your flat bases, your cup and handles, your pullbacks, or any of that stuff, same as I do. And that's where you start, and that's narrowing down what you're particularly looking at. But then you can start to use the actual price action to generate the entry exit signals. And that can be either in the lead up to a pivot point, or it could be as things start to top out, and that's where you're going to use to sell into strength and things like that. So you're looking for those price action signals, if you like, to tell you when's the optimum time to exit. What it really involves is about observing the relative movement of price compared to the previous bar or bars. Generally, I only look back one bar, sometimes two. If I'm considering an entry and there's 3 bars all with higher lows but equal highs, that's a very valid thing that you'd be looking at. But you're actually looking at what's happening on the day of entry. You're looking at that particular bar. The other thing is really about observing how price is moving towards that support or resistance area. The closer it gets, the more you need to be looking at what is price actually doing, and actually look at it and observe it rather than looking at highs, lows, and closes and all that kind of stuff. And I guess that's the next point that I've got there, that the open doesn't really matter in price action at all. It's the high, low, and close, and one of those will be the dominant feature of any particular bar. And it depends on the position of that bar in relation to the previous bar, which one is actually dominant. That sounds like a lot of kind of gobbledygook sometimes, and I probably need to provide an example of that. But for instance, if you are looking at something approaching an all-time high, what you're most interested in is what's happening at the lows. You're not really that concerned about where the close is, because what you're looking at is what are the market participants doing? Are they driving it lower or are they driving it higher? And where is the new accepted fair price for that stock? So whereas if you're looking at buying a dip or something like that, you may be looking at the highs, or you may well be looking at the closes. But they've all got kind of equal weight while the bar is forming. But once it's closed, then one of them will be the dominant factor in it. And really, it's used to supplement technical analysis with this bar by bar analysis. The key point about price action is you're trying to judge what everybody's doing, what their actions are, and what the next bar is going to look like. That's ultimately the aim of it. It's a forward-looking discipline rather than what has that than a rearward-looking discipline. So that's the kind of hard part of it is to throw away some of all that stuff you've been trained in around technical analysis that's lagging and all that kind of stuff, because price action's forward-looking rather than lagging. Another one that I've thrown in at the bottom there is micro trend lines that confirm the expected price action, give you a high probability entry and exit, and that's where you can kind of turbocharge some of this stuff. This is a real world example that I just closed out today at lunchtime your time. It's the Nasdaq E-mini that I'm trading, and I don't use any technical indicators when I'm trading futures at all. But you can see what pretty much got on that chart is a couple of support and resistance areas. This purple line here on the entry, that's the previous day's high. Sorry, that's the previous day's high, previous day's middle, and previous day's low. The reason I've got them is because institutionally they are important to institutional investors who mostly trade this particular instrument. So institutional investors, and this goes back to what are market participants doing, institutional investors want to get best average entry, and the best average entry that you can achieve is at the midpoint of the day. So we use that as our kind of key feature, and if stocks go above this line, then we're looking at what's happening in price action to go long, and if it breaks down below it, we're looking at price action to go short. Now, as I said, I was fishing, and before this I had 3 or 4 attempts at it on Tuesday, I think it was, and on Monday I had a few attempts at it, and I made a few hundred points, but not a huge amount. But you can see here, dips below, I'm expecting it to come back up and retest this line. It surely does, and I get a micro trend line that's pointing down the way, so when it confirmation bar here closes under there, I decide to go short if it goes lower, which it sure does. Initially, I'm aiming for this blue line here as my profit target, but it screams through that, so move our stop up to above this bar, and then we just see what happens. If it's going to go lower, we will get a kind of retest. So it breaks that low, then it goes up, doesn't quite get to that high, so I've got another micro trend line, and again, price sinks lower. Does the same again here. I drew this trend line. This is towards the end of the day. I think this is about 15 minutes before the close. So if it closed above that, I was going to put an exit order above that bar, which I did, and it then sank further down, so held it overnight. And you can see I've kind of repeated that process during the day, and then eventually it comes up, retest this micro trend line that I've drawn, and there's the classic price action pattern. I think I mentioned this last week as well. The big move up, the pause. As soon as you see that pattern, these 2 bars here in any chart anywhere, you know it's going up. So stop was in there, yeah, and I duly get taken out of the trade at that point, and that gave me a 10.2 RR thing. So, it's a $20 contract, so I was risking, what was I risking, $800 or something like that, and you turn that into the 10 to 1, so you make a couple of thousand or whatever, or $8 grand, whatever. So that's the kind of how that price action stuff works, and that's just pure trading, if you like, rather than looking at any technical indicator that's going on. Some texts that have some good chapters on it. So, as I said, these can be they're kind of heavy going. You really need to dive into them pretty deeply, reread, understand the message, take it away, think about it, all that kind of stuff. Probably the key one is this Al Brooks book. It's a good text, but from the first paragraph, it'll have you scratching your head. It's a really intense read, and not something you can read in one go or anything like that. You need to take it in bite-sized chunks. Stock Market Wizards has got lots of good price action examples in it. They're not called out specifically, but once you've got a basic understanding of what price action is, you'll start to see them and pick them up as he talks to the various traders and they tell you about the big trades and all that type of stuff. You see it comes through again and again and again. And Alexander Elder's book, Coming to My Trading Room, the first, I think it's about 9 chapters. I've got heaps of post-it notes and stuff all over that book because it kind of does go into all the different market participants and how to take advantage of them and what their price action footprints, if you like, look like within it. And then I put in a couple of YouTube videos in the Mark Douglas one. These are playlists. So Mark Douglas, I think in the first and second part of that, and they're about an hour and a half long each, and I think there's 4 of them. Goes into why does price move and how does it move and who makes it move, and that's important. And he refers to price action stuff over and over again during those. Alexander Elder's stuff is similar. It's kind of it's YouTube stuff around the book. Again, it's scattered throughout it. But again, I think the first, and that's about 12 hours long, I think, all that stuff. But the first 2 or 3 hours has got most of it in it. And then there's a quite a good little basics video there at the back end. But even that can be a bit difficult to get into if you don't know the terminology and so on that they're using. So thank you very much. I don't know if you get any questions either of you, or that was just too much whoosh.
No questions on my end. How about
really
you,
good.
Tish?
Yeah, no questions on my end. That was really really good. When I'm on IBD Live, they always have this one lady on there, and he does the future market, and it's
Yeah,
always fascinating to watch what he looks for and all that. Anne Marie Baird, Bayyard,
right.
and he's it's incredible. And then I also was reading a book where on price action and this one lady, I don't know her name. She just like, for her and her husband, like sat down for like 6 months and just studied before they ever placed any money
Yeah,
on doing it.
I think certainly price action is more simplified in these, one instrument type markets like the futures market or whatever. So you were trading E-mini or NASDAQ minis or something like that is much easier, because you have all the market participants are engaging with that market, if you like. Individual stocks, you tend not to get many scalpers and things like that in it, so some of those type of action you tend not to see very often. So you're looking at more that kind of swing trader footprint and looking at what's going on there, or the institutional end of stuff. But really, ultimately the key to all this stuff is it's all about how price reacts around certain key levels and what the footprints to look for actually are. And that you can, if you pull up a chart of NQ or EQ or any of these futures markets and just watch them for a few hours, on a 5-minute or a 2-minute chart or something like that, you start to get an idea of where price is reacting and how it reacts, and you start to form an eye for some of that, where the patterns are, and you start to form your own ideas of how you can take advantage of the situation. And that's kind of the key to it all, because everyone's their own individual, and you can't follow any particular anybody else particularly well within this type of stuff, but there's key things that happen over and over again, and it's like you hear people in the swing trading community talk about, oh, my stop was run and all that kind of stuff, and they're actually not wrong, because all the kind of PA type guys know where those stops are going to be, and they know how to hit them and how to take advantage of the fact that there's going to be an equal and opposite reaction in the other way, So they're actively trying to encourage that behaviour so that they can then make their money, if you know what I mean. These guys in the prop firms and all that type of stuff. So probably doesn't happen quite so much in the stock market, but it certainly does happen within futures and all these kind of things, So, but it sort of forces you to think of the other side of the trade, really, I guess, or what it's doing, and consider the human behavioural aspect a lot more. So, okay, that's it from me, Mike. If you want to cut the recording,
right. Yeah, thank you.
I think that if people are more interested in taking a few examples and picking them apart, I'm certainly happy to do that in one of these weekly ones as well, just to kind of start to put a bit of meat on the bones.